Welcome to Talk Tickers, your go-to source for in-depth earnings call summaries. Today we're diving into the second quarter 2025 financial results for Dave Inc., ticker DAVE. And this is a fascinating one because the numbers paint one picture, a really strong one, but the market's initial reaction was, well, quite another. It's a bit of a head-scratcher.
Indeed. It's, a classic case of strong operational performance meeting, let's say, investor skepticism, or maybe just confusion. We'll unpack why Dave Inc. had a record quarter, the strategic shifts they're making, and trying to figure out why the stock still took a hit.
Okay, so let's get right to the chase. The headline numbers for Q2 2025. Dave Inc. absolutely crushed consensus estimates, like really crushed them. Non-GAAP diluted EPS came in at an impressive $3.14. The consensus was what, $1.94?
$1.94, yeah. So they beat by a substantial $1.20.
Yeah.
That's not a small beat.
No kidding, a knockout punch on earnings.
And on the revenue front, same story. They reported $131.7 million. Consensus was looking for about $113.6 million. So that's a beat by over $18 million. And it marks a remarkable 64% year-over-year increase. Their fastest growth rate in, I think, over 5 years.
64% year over year. That's accelerating growth.
Exactly.
Okay.
And it doesn't stop there.
Okay, tell me more.
Adjusted EBITDA more than tripled compared to last year, hit $50.9 million.
Tripled.
Yeah, tripled, achieving a 39% margin, which for a fintech growing this fast is pretty remarkable efficiency.
39% adjusted EBITDA margin.
And the gross margin.
Also strong. Non-GAAP gross margin hit 70%. That expanded by about 500 basis points, so 5% compared to last year. Shows real leverage.
Okay, so profit's looking really good.
Yeah.
What about the user metrics, the sort of underlying health?
Also strong. Monthly transacting members grew 16% year over year up to 2.6 million. Solid user growth.
Yeah.
Extra cash originations, that's their cash advance product, surged 51% to $1.8 billion. Huge jump there.
51%, okay. And Dave card spend saw a healthy 27% increase year over year, hitting $493 million. Plus, they brought in 722,000 new members. And they did it at a customer acquisition cost, or CAC, of just $19. Very efficient acquisition.
$19 CAC. That's impressive. Stellar numbers by any measure, wouldn't you say? Just across the board.
Absolutely. Top line, bottom line, user metrics, efficiency.
Yeah.
It all looks fantastic on paper.
Yeah, as we mentioned, the market had a very different take. The stock saw a significant decline right after the announcement, which brings us to the core question.
What gives? Why the disconnect?
Exactly. Okay, let's unpack this. What were the key drivers behind Dave's record performance? And what are these strategic moves they're making? Let's start with maybe how they actually make money from users.
Right. So a big factor this quarter was getting the full benefit of their new fee structure. Plus, they saw significant average revenue per user ARPU expansion.
Okay, ARPU going up.
Well, the big change was successfully rolling out a $3 monthly subscription fee for all new members. That started mid-June. They said extensive testing showed minimal impact on conversion or retention. So basically, it adds directly to lifetime value, LTV.
Right, so it's creative, a big jump from the old $1 fee they had for years, right? Since 2017.
Yeah, a long time. But crucially, it's only for new members. Existing members are grandfathered in at the old rate.
That's a smart way to do it. Probably avoids upsetting the existing base. Still, a bold move. You don't triple a fee lightly.
No, and they emphasized it wasn't, a knee-jerk decision, lots of testing, data analysis. They looked at the impact on signups, on people sticking around. The fact that conversion rates held up suggests new users see the value even at $3. They don't know the old price. Right.
Good point. Okay, and speaking of efficiency, you mentioned the $19 CC. Their payback period also improved.
Yeah, dramatically. It's down to an estimated 4 months now. Last year, mid-year, was 5 months.
So they get their acquisition costs back in just 4 months.
Exactly. Shows really strong marketing discipline. They're not just chasing cheap signups. They're focusing on investments that bring back the most profit dollars quickly. It's a smarter growth strategy.
Okay, makes sense. But with that huge surge in extra cash originations of 51%, you have to ask about credit risk. Did delinquencies go up too?
Yes. And this is probably where some of the market nervousness came in. The 28-day delinquency rate did increase by about 37 basis points year over year, landing at 2.40% in Q2.
Okay, 2.40%. So an increase. For some investors, that's a potential red flag, right?
Yeah.
Especially in FinTech lending.
Definitely. But here's where it gets really interesting and where management offered a specific explanation. They attributed about 19 basis points of that increase, so more than half of it, to a temporary third-party issue, some kind of delay in extra cash settlements.
A third-party issue, not their own systems.
Correct. And the key thing is, they said it's been resolved, fixed in July.
Okay, so if you back that out, the underlying increase was more like 18 basis points.
Around 18 basis points, yeah. Which, management stated, is within their internal guardrails, their acceptable risk limits. They also emphasize their strategy is about maximizing gross profit dollars, not just minimizing loss rates at all costs. It's a balancing act.
So they're comfortable with a slightly higher delinquency if it means much higher overall profit from the extra cash product.
That seems to be the philosophy. And to manage this better going forward, they're now testing Cash AI V5.5.
Their underwriting model, V5.5, sounds like a significant upgrade.
It is. They said it's trained on more than twice the features of the previous version.
Twice the features. What's the goal there? Better predictions.
Enhanced precision, basically. It's designed to fully bake in the economics of the new $3 fee structure. And the aims are better risk splitting, so identifying good versus bad borrowers more accurately, potentially leading to higher average origination sizes for good borrowers, and ultimately lower delinquency rates overall.
And when does that roll out?
Deployment is expected later this year. So if it works as planned, it could significantly improve their credit performance moving forward, turn that potential headwind into a tailwind, maybe.
Okay, that's a key thing to watch. Now, shifting gears a bit, beyond the fees and the AI, there was a big strategic move on the funding side, right? Something about their balance sheet.
Oh yeah, this is huge. The partnership with Coastal Community Bank.
Right, Coastal. What's the deal there?
Coastal is becoming the primary funding partner for Dave's extra cash receivables. What that means is a big chunk of those receivables moves off Dave's balance sheet.
Off balance sheet. Why is that important?
Two main reasons. One, it reduces Dave's direct funding obligations. They don't have to borrow as much themselves to fund the advances. Two, and this is critical, it lowers their cost of capital.
Okay.
By 200 basis points, that's 2% compared to their current warehouse line.
200 basis points lower cost of capital. That's a massive efficiency gain. What does that translate to in like dollars and capacity?
Well, it's expected to unlock substantial liquidity. They said well north of $100 million. And it increases their total funding capacity up to $225 million from $150 million before.
Wow. Okay. So much more firepower.
Exactly. Gives them a lot more flexibility. And their stated goal, which is pretty ambitious, is to completely eliminate warehouse line debt from the balance sheet by mid-2026.
Eliminate it entirely. That would really strengthen their financial position. Shows real maturation.
Definitely a game changer for their capital structure.
Okay, so record results, new fee structure working, ARPU up, payback down, a new AI model coming, and a much more efficient funding structure. Given all of that, what's the outlook? What are they telling investors to expect for the rest of 2025?
They raised their guidance significantly. Very strong signal of confidence. For the full year 2025, they now expect revenue between $505 and $515 million.
Up from what before?
Prior range was $460 to $475 million. So a big lift.
Okay. And adjusted EBITDA.
Also a big increase. New guidance is $180 to $190 million. That's up from $155 to $165 million previously.
So if you look at the midpoint, what kind of growth does that imply for the full year?
The midpoint implies annual revenue growth of about 47% and adjusted EBITDA growth of, wait for it, 114%.
114% EBITDA growth. That's staggering.
It shows tremendous confidence in that ARPU uplift continuing, the marketing staying efficient, and all these strategic changes really compounding.
Right. But let's circle back to that market reaction. Because even with that kind of guidance hike,
The stock tanked.
yeah, down almost 18% on the day on heavy volume. Pre-market, it was already down nearly 13%. It wasn't a small dip.
No, it was a serious sell-off, and it really highlights that disconnect we talked about. Management is painting this picture of, durable ARPU, strong engagement, incredible operating leverage, but traders, it seems, latched onto that slight drift in credit metrics, even with the explanation about the third-party issue.
So the fear around credit quality, however small the actual underlying increase was, just overshadowed everything else.
It appears so. It's like, investors sometimes have selective hearing. They hear the part that confirms their potential fears, especially with FinTech and credit risk. The fact that the delinquency did tick up, even if mostly explained away, might have been enough of an excuse for some.
And maybe the stock's previous run played a role. It had a huge run-up leading into earnings, right?
Oh, absolutely. Crucial context. The trailing total return over the year before the call was over 416%.
100%. Okay, yeah.
So when a stock runs that hot, any slight disappointment, any perceived crack can trigger massive profit taking. It becomes less about fundamentals, more about locking in gains.
Right. So a mix of maybe some genuine credit concern amplified by a need to take profits after that huge run.
Precisely. And connecting that to the bigger picture, Dave's capital allocation strategy seems flexible. They want to reinvest in growth, keep building up that dry powder for potential M&A, maybe do some share buybacks, and that coastal partnership we discussed. It gives them a ton more leverage and cash to actually execute on that strategy.
Makes sense. What about other potential headwinds? There was talk about data aggregator fees potentially going up, like the cost to access bank data through services like Plaid.
Yeah, that's an industry-wide concern, especially with some disputes like the one involving JP Morgan. Management addressed it. They believe it's not a done deal, that prices will shoot up. They mentioned industry efforts and the CFPB potentially defending free consumer data access.
Okay.
But even if fees do rise, Dave feels they're well-positioned. They think they can optimize how they use data. And because of their scale, they expect any cost increases would likely be shared across the ecosystem, not just absorbed by them. They're watching it, but don't seem panicked.
And M&A, are they actively looking?
They are assessing opportunities, yes, but with a very clear focus, which I think is smart. They're looking for deals that either boost distribution, help them acquire customers differently, or deals that are accretive to ARPU for their current members. Think new subscription services or maybe expanded credit products.
So disciplined M&A, not just buying growth for growth's sake.
Exactly. It has to fit strategically and improve the economics.
All right, perfect time to shift gears. For the investment committee members listening, it's time for our This Is Not Financial Advice segment.
Yeah.
Given this, frankly, perplexing market reaction to what looks like incredibly strong results and guidance, what's an outrageous but plausible trade idea you've been thinking about?
Okay, disclaimer first, right? This is purely hypothetical, informational, not advice. Do your own homework.
Absolutely. Not advice, just an idea.
So for someone with a contrarian view, maybe a bit of patience, I'm thinking about a long-term bullish call spread on Dave EE, specifically targeting the Q4 earnings cycle, maybe even early next year.
Okay, a bullish call spread. Buying one call, selling a higher one.
Exactly. Let's say, hypothetically, buying the Dave EE January 2026 $220 call and selling the Dave EE January 2026 $250 call. This gives you defined risk, defined reward. You're betting on a recovery, but capping your upside, which also lowers your cost. And you're using the current, arguably depressed price after that sell-off.
So the thesis is basically the market overreacted, and eventually the fundamentals will win out.
Pretty much. The implied volatility likely spiked after that earnings drop, which can make selling that higher strike call attractive in the spread. The core idea is that the market will eventually, digest the real story here. The improved ARPU, that super capital efficient coastal deal, the new fee structure actually working, and the potential catalyst. Maybe it's the rollout of Cash AI V5.5 later this year. If that delivers on better risk management and lower delinquencies.
That could shift the narrative significantly.
Exactly. It could be the trigger that makes the market reevaluate and push the stock closer to what management's guidance suggests its intrinsic value might be well above where it is now. It's a play on fundamentals overcoming short-term sentiment.
But the risk is the sentiment stays negative, or maybe those credit metrics do worsen.
That's the risk, absolutely. Or if the new AI doesn't perform as expected, but the spread structure limits your potential loss compared to just buying calls outright.
Interesting. A defined risk bet on a fundamental recovery. Okay, let's recap this deep dive. Dave Inc. delivered a truly record-setting Q2. Blew past expectations on revenue, blew past them on non-GAAP EPS, and they significantly raised their full-year guidance.
Yeah, and strategically, they're making big moves. That new $3 fee seems to be sticking. Cash AI V5.5 promises better underwriting, and the Coastal Community Bank partnership fundamentally improves their funding efficiency and capacity, positioned for profitable growth.
But the immediate market reaction was sharply negative, likely a combination of profit-taking after a massive run-up and maybe some lingering, perhaps overblown concerns about that small uptick in delinquencies.
Right. Suggests the underlying fundamentals point one way, but market sentiment, at least initially, went the other. And just to reiterate, Please remember that all information discussed here on Talk Tickers is for informational purposes only. It should definitely not be considered financial advice.
Always do your own research, consult with a qualified financial professional before making any investment decisions. We really appreciate you joining us for this dive into Dave Inc.'s Q2 earnings. Definitely a complex picture. We encourage you to share your thoughts and keep digging. Until next time, stay informed. Maybe the final thought here is, can Dave convince the market that its tech and strategy truly manage credit risk effectively, even while growing rapidly? Or will that fintech lending skepticism linger? What do you think?